Hey, good morning, everyone. Morning, everybody.
Good
Good
morning.
morning, Professor.
Hey, good morning, Jordan. Good morning, everybody else. I see.
Morning.
Good morning, Aisha.
Good morning.
Good morning, Victoria. I see 11. Oh, why 10 now? I mean, it was okay, 10 people. I guess Jason was temporarily disconnected. Um, so, okay, so let's see. There are 10 people in the collaborate and in the discussion board. Let me just quickly check today's forum. I see 13 people in actually 12, right? I have two postings, so 12 people. And I have looks like I'm having more people here. So it looks like I have 13 people. Um, so just make sure, please, if you are here, but if you haven't yet signed into today's forum, please don't forget to do that. Now, so in our last class, let me use my whiteboard. Okay, a lot of things are okay. It's as if what's going on? Okay, it doesn't matter. But I think I lost. Doesn't matter. I can start anywhere. Um, so in our last class, we started.
Sorry, Professor. I had to get back in. I got kicked out.
Yeah, no problem. No problem. No problem. Uh, from the company's perspective, right? From the firm's perspective, right? The reason we talked about the financial statements was for fundamental analysis. And the fundamental analysis is basically the analysis based on the financial fundamentals. And as I said before, right? No, I cannot. Okay. Um, as I um, as I said before, the whole point is how profitable the company is, and how do you measure the profitability of the company? Of course, return on investment. I mean, if the return on investment is high, that's a company that is doing well and being very productive and being very profitable, right? So, how does the company measure its return on investment? And I said, there are largely two two ratios to measure. Actually, there are more than two. Actually, there is uh, return on equity, return on capital, return on total assets, and return on sale. Right? At least like four, five, measures of profitability, but most commonly used measures are return on equity and return on assets. Okay, they are two most representative measures, and so this is from the company's firm's perspective, right? from the firm's perspective. And then in return on, the whole point is, and I already gave you what return on equity, formula for return on equity is. This is called the jitter and jittery, right? It's not that my hand is jittery, but the the rubber tip and the screen is not very steady. It's profit over total equity, and return on assets. It's also profit. Roughly, it is called profit, but we will need to further redefine. It's actually this profit here means net profit. In other words, EAT, earnings after taxes, at time 1, and then equity over, equity at time 0. Okay, and then in return on assets, profit means actually EBIT. So it's operating profit, right? EBIT at time 1 and total assets at time 0. Okay. Now, and let's go back to the but let's let's analyze it, right? Let's analyze it. In other words, profit over equity, but before profit over equity, let's think about this profit, operating profit over total assets. If you think about it, I've been telling you, company is defined by the size of its assets. Isn't that right? Because the size of its assets is defines the production capacity. And in our example, remember, in our example, we had $10 million of almost $10 million of total assets, and about 95% of it was physical assets. Isn't that right? Remember that, Dell, computer manufacturing, our total assets was about 10 million. I closed that file, but I'll have to open it again. Right, remember this, right? The total assets is almost 10 million, right? And the physical assets, in other words, plant and equipment, building and land, the real assets, it was almost 9.5 million before depreciation, right? At time 0, the total value of the fixed assets were almost 9.5 million, right? So 95% of the total assets was the real assets or physical assets, which are basically the production facility, right? So the size of the total assets defines the production capacity. So the bigger the total asset size, the bigger the production capacity. The bigger the production capacity, more outputs will be produced. As more outputs are produced, the more sales will be made. More sales made, more revenue generated. And then the more sales are made, that means the company is occupying more market share. And there is, a good reason why the number one player, the biggest player in the industry, the biggest, guy in the industry is the number one player, and is why it is, biggest in market share and why it is biggest in sale, because it has the biggest production capacity. Make sense? But then, so the size of the company is determined by the size of the total assets, and the size of the total assets determines the production capacity, right? But if you think about it, total assets are means of production. In other words, it's a vessel, right? Total assets are nothing but a means of production, right? They are physical capital, mostly physical capital, right? And the physical capital is a means of production. The means of production is what it's like your body, right? Your body, and the output, the EBIT, is like the work your body does. How is the work measured? Work is measured by the weight. I mean, in physics, right? Physics, work is measured by the weight and the distance moved, right? Let's say you have 1 ton of weight at point A, and if that 1 ton of weight is moved to point B, right? How much force is applied, right? And what is the distance between point A and point B, right? That defines the work. In other words, obviously you will need to have a lot of horsepower, right? You will need to generate a lot of horsepower to move 1 ton of weight from point A to point B. And if it is, either it could be an engine or a motor, or it could be your own body. But think of it this way: if your body lifts 200 pounds of weight, right? If your body moved 200 pounds of weight, that's the output of your body, isn't that right? And your body is the vessel, right? And you want to know the efficiency. You want to know the efficiency of that vessel. Of course, if you can, let's say you are 200 pounds, you weigh 200 pounds, and you are full of muscles, right? You're full of muscles. The weight that you can lift, will be, or the weight that you can move will be much more than if your body is just 200 sheer 200 pounds of sheer fat, right? Of course, if you're to think about it, we have two people here. One person, they are both 200 pounds. One person is 200 pounds of sheer muscle and bone. The other guy is 200 pounds of sheer fat. Of course, there will be bone. Of course, nobody has zero fat, right? Because if you have zero fat, your bones will crack. I mean, you don't have any like synovial fluid. You don't have any. Your body will collapse right away. But let's say someone with 200 pounds of muscle would be more productive, right? In terms of lifting weight or moving a very heavy object, right? So that is the way you measure the productivity. Now think about it, the productivity of the vessel, right? Now, so if you think about it, total assets is like your body. And if your total assets is 200 pounds of sheer muscle and bone, right? The EBIT will be greater. Also think of it like a car, right? Your total assets is like the car. And then EBIT is like the miles driven. Okay, so actually, you know what fuel economy is, right? Fuel economy is basically also called mileage, right? Gas mileage, right? Gas mileage, right? Whatever you call it, gas mileage or fuel economy, they mean the same thing. And how is gas mileage calculated? It's obviously miles driven, right? Number of miles over number of gallons. Isn't that right? That's what gas mileage is, right? So if you have a car, and let's say your car has a 20-gallon fuel tank. You have 20-gallon fuel tank. You fill it up with, then that's 20 gallons, right? And then you drive until you run out.
Welcome to helpyourmath.com. This video will help you for your statistics calculations in the future. You can see the first problem we have on the right side. Finding faster.
Okay. Who would be?
Is 31.
You should be paying. Okay, you should be paying attention to this class, right? While this class is on, right? And if your microphone is on, the background noise will inevitably interfere, right? Aisha, was it you? Your microphone was on.
Yeah, so sorry.
Okay, so please, mute your unless you have something to say. Please, keep your microphone muted, right? Where was I? So think about it. How you calculate the gas mileage is not a bit, it's quite obvious. You drive until you run out of gas, and if you're 20-gallon tank, let's say you fill 20 gallons in your gas tank, and let's say you ran out at 600 after driving 600 miles. Then what is that? The gas mileage will be 30 miles per gallon. Isn't that right? It's going to be 30 miles per gallon.
Yes.
Yeah, and the higher the number, the higher this number, right? The more efficient the car or the engine is. The car is, in general, right? Now think about it. This type of gas mileage is a typical example of what they call output to input ratio. Now think about it. This is a very good example. This is a typical example of output to input ratio. Isn't that right? Output to input ratio. And output, no matter what, this is a very simple, very basic concept. Even an elementary school kid can understand it. Fourth grader, as long as you're more than fourth grader, or even even not a very smart sixth, if not very smart, still even a sixth grader can understand, right? So even the expression, right? Even the expression, you get the most mileage out of this. I mean, people figuratively, it's not gas mileage, but when they say, "Oh, this way you get the most mileage out of it," if they say that, when they use that expression, that means it's a metaphor, actually, right? Isn't that right? It's a figurative speech. It's a figurative speech, right? You're just figuratively saying that this gets you the most bang for the buck. I mean, no matter what expression, that most bang for the buck, or most value for money, all of those expressions basically point to one thing: output to input ratio, right? Gas mileage is a very good example of output to input ratio. And if you think about it, of course, total assets are not input, but rather, I mean, it's a kind of input because, but it's more like a vessel rather than input, right? It's more like a vessel. So if you think about it, the EBIT is the output of this vessel or machine. It's is vessel spelled with E? Vessel. Quickly check. Vessel. Yeah, spelled with E. Vessel. Yeah. So it's measuring the productivity or efficiency, right? Measuring the productivity or the efficiency of the vessel, right? Which is our total assets of this company. Now, but then what is ROE? ROE is also the same in output to input ratio, but specifically for the equity holders, for the owners of the company. Think about it. Equity is only one part of the total assets, right? There are two components of total assets: equity and debt, right? But
Yes.
so equity is only one component, right? And EAT, the net profit, right? Earnings after taxes, or the net profit belongs only to the owners of the company. Isn't it right? So in other words, the shareholders of the company, or the equity holders of the company. So from the equity holders' perspective, from the shareholders' perspective, or from the owner's perspective, right? What matters to them is the productivity of the equity, right? So again, it's the same thing. It's the output to input ratio, right? And then this is the output. EAT is the output, of course. Oh, God. So difficult. Okay, I'll drag it down. So this is the output, right? From the stockholder's perspective, this is the output. And this is their input or their vessel. I mean, the vessel and input are not exactly the same thing, but think about it. From shareholders' perspective, yeah, it's an input in a way, right? Because I buy, if I bought the stock, I bought the shares of Dell, so I'm a partial owner of Dell, right? And then if my so if my if Dell, if the equity is pool of all these shares, right? I mean, the equity is the total, it's aggregate. If my equity was put into good productive use, in other words, the company acquired the good production equipment and operated well, operated productively, then my input, in other words, I provided equity to the company. My input would bring a very hefty output. It will bring very high output, right? So it's basically whether this should be considered as vessel or input is not important. The point is it's input no matter what, right? That's what my investment in that company. So it's my input in that company, and it should give it should give it should generate output, and the ratio will tell. The higher this ratio, that means the higher the ratio, the more profitable or the more productive the company is, right? Makes sense? And then why? Next question is, why do we use EBIT for total assets? Sometimes they use EAT. Also, sometimes another version of return on asset. Another version is another version is EAT over total assets. But then this is wrong. I mean, I wouldn't say it's wrong, but it's not appropriate. Why? Think about it. We all know total assets break down into equity and debt, right? But think about it. EAT the net profit belongs only to the equity holders, right? Debt holders or lenders or creditors or bondholders, they all mean the same thing. Debt holders, this doesn't belong to debt holders. Debt holders are not owners. They are just lenders, right? So EAT has nothing to do with the debt holders. You understand? Net profit has nothing to do with the debt holders or the lenders. So how does this, from the debt holders' perspective, this may help. I mean, this would provide insight to the equity holders, but it has nothing to do with the debt holders, right? So therefore, from the debt holders' perspective, using this EAT for return on assets is kind of, irrelevant. I mean, EAT is irrelevant to them. So from the debt holders' perspective, and since we are talking about return on total assets, unless you are equity holder, from the equity holders' perspective, this is okay from the equity holders' perspective. But from the debt holders' perspective, this is the proper way of doing it. Okay, does that make sense? Now then, let's think about. Okay, we are almost as if. Okay, it's whiteboard. I can write anywhere. And now, back to the basic, very fundamental concept of ROI, because in topic 1, ROI was, it means, holding period return, right? Of course, it can mean annualized. I mean, if you annualize the holding period return, then you have annualized return. But what is the definition of holding period return? You will have, first of all, capital gains, which is the difference in price of the asset over n years, and the sum of all the cash flows during that time, during that n-year period, divided by PT. And what is this called? It's called capital gains. Is that right? And what is this called? That's called income. And PT is the initial investment, isn't that right? That's the initial investment. Initial investment. But then if you think about it, the big picture is basically the same thing. I mean, ROE, right? ROE or ROA, return on equity or return on assets, is the same thing. What's going on? Think about it. EAT is basically EAT at time 1, right? Over 1 year period, right? Of course, when you the basic operating cycle is quarterly, but we are using 1 year time frame, so that our return on equity at time 1, right, is EAT at time 1 over equity at time 0. Of course, time 1 is the end of this year, the first year, as well as beginning of the second year, and time 0 is the beginning of this year as well as the end of the last year, right? So that's 1 year. And our input, this is our initial investment. Isn't it right? This is our initial investment at time 0. This is our initial investment. Okay? And this is our basically capital gains, right? At time 1. Plus, if there is any cash flow, right? During, between time 0 and time 1, right? So it's the same concept. It's the same concept. Now, so basically, and think about it. Our EAT was, this data, EAT data, we got it from where? Where do you think where did we get our EAT data? Anyone? Where do we have to look to find EAT?
The income statement.
Yes. Who said that?
Natasha.
Natasha. Okay, Natasha. Yes. You got 0.25 for that. I'm just.
Thank you.
You're welcome. So today is 10/20 already. Oh, October 20th already. And you guys are fnb100 section 1100. Yeah, Natasha. So you got 0.25. Yeah. So we got the EAT data from income statement. Of course, income statement at time 1, not time 0, right? Because we need, I've been telling you, we need 2 balance sheets and 1 income statement. And of course, at the end of this year, we will be looking at income statement at time 1, not at time 0. But we need, balance sheet at time 0 and balance sheet at time 1, because all the EAT is the output of the equity at time 0. So what do we have to where do we have to look? Where do we have to look? Okay, Nolvia, I'll get to you soon. I'll get to you after addressing this. Where was I? Yeah, my question was, so where do we have to look for the equity data? Where do we have to look? Now, for EAT data, we had to look into the income statement. For equity data, where do we have to look? Anyone?
The balance sheet.
Yes, balance sheet. Yes, the balance sheet. But the balance sheet. Yeah, I got you, Jason. Balance sheet of time 0 or balance sheet of time 1?
I believe time 0.
Yeah, you're right, Jason. So you got 0.25 and also another 0.25 for correctly, saying time 0. Yes, because as I said, that EAT is the fruit, right? That EAT is the fruit of the workings of that, equity at time 0, right? And then that means, so here, if you look at the balance sheet, right? And first, let's say, I have a pen. Why am I doing this? I have. income statement, right? I won't write everything. And so the conclusion of the income statement is EAT, and of course that's the time one. And then in balance sheet, right? Balance sheet of time 0, balance sheet of time 1, and then you will have equity at time debt and equity. You will have debt on the liabilities and equity side. Debt at time 0, equity at time 0. You'll have total assets of time 0, and balance sheet 1, you will have debt at time 1, and you'll have equity of time 1, and you'll have total assets of time 1. Now think about it. This EAT at time 1, this is capital generated from operating activity, right? We all understand profit is the capital generated by operating activity. So in nature of capital, or in nature of capital, or in type of capital, right? Or in capital component, in terms of capital component, what is EAT? What is EAT in terms of capital component, or in terms of nature of capital? You understand? There are only, do you understand what I'm talking about? Because what does that mean? Nature of capital, what does that mean? How many types of capital are there? How many types of capital are there? Anybody?
There were 2, right?
Yeah, Jason, you're right. Jason, only 2. What are they?
There were 2. Can someone help me over here? Can't remember.
That's what we have over
here. It's EAT, owner's equity, and liability.
Yes, you're right, Jason. So I'll give you another 0.25. Yeah, it's either debt or equity. Isn't that right? Only 2 types of capital, debt or equity. So then in terms of nature of capital, what should this be? EAT, is it in terms of nature of capital, is it debt or is it equity?
I believe it's equity.
Yes, you're right. So Jason, you got another 0.25. So you've racked up total of 1 point so far, right? Yes, it's equity, clearly. Because why? It belongs to the owners, right? Net profit belongs to the owners. So in terms of nature of capital, it's equity. It can never be debt. So that means what? Think about it. This equity at time 0 is what they call paid in capital. In other words, that's paid in by the stockholders. That's the in the primary market, right? In the primary market, when this company went IPO, right? They sold the stocks for the first time in the market, and then the first round of buyers, what they paid went directly to the company, and after that, the trading happens between in the market between the investors, right? I mean, after the first round of the market, which is called primary market, the money doesn't go to the company. It just changes hands between investors. Make sense? If I was in the primary market and bought the stock of this company in the primary market, my money went to the company directly. But after that, if I sell, it's in the market. It's a secondary market. It's called the secondary market. In the secondary market, the hands change. The hands change only between the investors. The hands change only between investors. So that's called, secondary market. So at time zero, and since time zero is the beginning of the time, right? Beginning of this company's history, the equity at time zero is the paid-in capital. And then at the end of the year, the company got this EAT at time one, which is the the internally generated capital, right? So then, because this is equity, internally generated equity, right? Not paid in capital, but generated equity, generated by equity generated by operating activity, right? Operating activity. So you must, this is equity, so it will be added to equity at time zero, and then that's equity at time one, right? Think about it. Unless they sold another round of shares during year one, which hardly happens. It hardly happens. But then equity at time one is simply equity at time zero plus EAT at time one. In other words, it reflects the EAT. Now think about it. So when you and when I say equity, that's aggregate concept. Aggregate, meaning equity means what? It's all the equity means the share stock price per share, stock price per share times number of shares outstanding. That's what equity means, right? In other words, it's the total value of the outstanding shares, right? So then what is the price per share? Price per share is simply, think about it. You divide it by number of shares outstanding. I will just skip outstanding because it's been explained verbally. If you divide it by number of shares outstanding, then it's called what? It's called book value per share. We understand already it's the stock price per share stock price. But when you say stock price, it means already per share. Yes, that's the book value per share at time zero. Book value. It's not market value. It's not market price, but book value. Book value. We call market price. book value is called value, but market price is called price. What's the difference? Again, the difference is value and price are not the same thing, right? We all know the value. Actually, there's no intrinsic value of Bitcoin is nil. Think about it. Intrinsic value of Bitcoin is virtually nothing. There's no intrinsic value. It's just the price. Market is crazy, and market prices Bitcoin for 60K. It's just like, there was the same thing back in the 17th century in Amsterdam stock market. It was 17th century. It's called, tulip frenzy or tulip craze, because in those days, tulip bulb was a speculative asset. Somehow, tulip trade was in such a huge, what's that called? Fad, and all over Europe. And then so there was so much demand for tulip bulbs. And so Netherlands at the time was the center of international trade and international finance. They had stock markets even in the 16th century, 17th century. And then they were betting on the price of the tulip bulbs. But look, the intrinsic value of tulip bulb, what would be the intrinsic value? I mean, even today, tulip is only for like visual pleasure, isn't it right? For if the tulips are in full bloom, it's a pleasurable sight to see. But other than that, there's no other intrinsic value. It's not like tulip is, can be used for, right? I mean, it cannot be eaten, or maybe you can, if you are really starving, maybe you can eat tulip flowers and petals and leaves and even the bulb, but it won't taste, most likely it won't taste good, and may not have, much nutritional value. Oh, what else can it be used for? I mean, can it be used as a semiconductor? I mean, does the tulip bulb, only pass the electric current by 50%? No, nothing like that. No industrial usage, no industrial utility, nothing. So intrinsic value of tulip bulb is, very low. But in those days, the speculative, speculative actions drove up the tulip bulb price. And one day the bubble busted. Everyone realized, it was clearly irrational. There was no intrinsic value, right? And then the market crashed. Now, those who were, holding a lot of shares in tulip bulbs, they simply lost money, right? It crashed. And Bitcoin is the same thing. It's only the market that's just driving up the price. The speculative, you just want to take part in that momentum, but it has no intrinsic value. That's why market price is called price, whereas book value is called book value, right? I'm not saying book value is the intrinsic value. It's called book value. There's intrinsic value is a separate thing. Intrinsic value is based on the future cash flow. Now, but book value is based on literally equity value in the book, equity value registered in the book, right? So that's what was paid in, right? Equity value at time zero is based on the capital that was paid in by the investors at time zero. Okay, therefore it is called book value per share at time zero. And then the same thing. I mean, I told you we have, and then think about it. We had equity, I mean, EAT. Oh, no. Where am I? No, no, no. Where am I? Okay, so where was I? Was it here? This is really crazy. Come on, I lost it. I think it was somewhere here. Excuse me. Okay, I'll have to start this all over. Okay, I think it is 12 o'clock, so it's a good time to take a 10-minute break. So let's take a 10-minute break and reconvene at exactly at 12:10. Okay. I lost that whiteboard, so I will try to recover it during the.
Maybe the whiteboard was trying to remind you of the break.
Yeah. Good point. Good point. Okay. All righty. Let's reconvene at 12:10.
Professor? Hello. Professor?
The question, so I can read the numbers. Thank you. Okay. So here we're going to take multiple calculations. We want to start with the first year, which is just a term of 1, and we have 10%, and our principal is $280. So $280
All right, we're back. We're back. Okay, we're back. So yeah, during the fortunately, I got it back. The whiteboard, right? I got that back. So I was talking about the book value per share, which is at time zero. It's basically equity at time zero divided by number of shares. Then think about it. Then if you then what is the book value per share? So let me. But then think about it. At the end of year one, we have EAT at time one, and actually, at the end of year one, we have EAT at time one, right? Well, once again, EAT is an aggregate concept. In other words, that's the net profit. And it belongs to the owners or the shareholders or the equity holders. So if you want to know what is your share of that EAT, right, then all you need to do is simply divide it by number of shares. Divide it by number of shares. Okay, my handwriting is not good. It's obvious, but at least it's not completely illegible. Now, if you divide EAT by number of shares, that's called what? That's called earnings per share. Think about it. Earnings per share at time one, right? Earnings per share at time one. In other words, that's profit per share, right? If you divide net profit by number of shares outstanding, and that's the net profit. That's the profit per share. Now think about it. Then, what is the then we all know that equity at time one is basically is equity at time zero plus EAT at time one EAT at time one, right? So if you divide, which is, if you divide EAT at time one by number of shares, then that's called what? If you divide EAT equity at time one by number of shares, right? That is book value per share at time 0. I'm in time 1. I'm trying to move this. Yeah. If you divide, right, then that's called book value
by per share
number of
time
shares.
1.
Number of shares outstanding, number of shares, right? That's book value per share at time 1. And then, because you're dividing the left-hand side by number of shares, you do the same thing to the right-hand side. If you divide it by number of shares, and if you divide it by number of shares, and number of shares is constant, it hasn't changed. Then this is, of course, equity at time 0 divided by number of shares, right? That's what? That's book value per share at time 0. And EAT at time 1 divided by number of shares, that's what? That's earnings per share at time 1. So then, what does this tell you? We come to the conclusion. I mean, it's very obvious. Move. Okay. Now it is moved too much. So then we come to the conclusion that book value per
share. Book value per share times 1 plus.
Yeah. Right. Book value per share at time 1 is
Plus
book value. Book value per share at time 0.
Right.
Plus earnings per share at time 1. Okay, that makes sense. So in other words, fundamentally, the price of the stock at time 1 must exactly reflect the earnings per share, right? At time 1, right? Which is the capital gains over and above the original, which is the capital gains over and above the original price book value per share. Once again, I'm not saying this is the market price. Market price should approximate book value, but market price could be above. Clearly, market price would deviate in the short run from the book value, because market price is basically a book value plus all the expectations built in, right? Market price that's why the market price always fluctuates, right? If the market has built a positive expectations about this company, then market price will be above book value, right? If the market has formed negative expectations about this company, right, market price will be below the book value. Makes sense? But as far as the book value is concerned, book value at time 1, I mean, it's obvious. All stock prices must reflect the earnings from the previous period, right? Book value at time 1 must reflect basically a book value at time 0 and the earnings, right, which is the output of the book value at time 0, right? So basically the fruit, this is the tree. This is the value of the tree at time 0, and this is the fruit, value of the fruit from the tree at time 1. So then the value of the tree at time 1 must reflect the value of the tree at time 0 plus the fruit, value of the fruit at time 1. Does that make sense? Right? Okay, I guess everybody can easily understand that concept. So this wraps up
that makes a lot of sense.
Yeah. I'm trying to use analogy as a simple and straightforward analogy as possible. Now, and the market price will vary, and market price will deviate from the book value because market speculates about this tree, and they speculate. Well, this year the harvest was good. The fruit they harvested from this tree was like 10% above harvest from last year. So then they form very positive expectations about this tree. So a lot of people will try to buy share in this tree. Then because of the strong demand, price will go up, market price will go up, right? But if the harvest was not that good, then they form negative expectations about this tree. So the demand goes down. As the demand goes down, the share price, if the tree is basically owned by multiple people, right? The share price will go down because of weak demand. Okay, so that's what market price is, right? So this wraps up everything about topic 2. So from next class we're gonna and topic 3 is time value of money, and we talked a lot about compounding at the beginning. So early part we can skip. But since there was something in the chat box, Novia said, Novia, are you here? Novia? Yeah, Novia is here. Novia, you're here, but you're not responding. So you got the table. You got the tax schedule. What Novia was saying is, in the 5th edition, this table is not in the ebook. The table, I don't know if you have a copy, if you have the textbook, a physical copy, it must have the table. But I don't know if it is. I don't have 5th edition copy, physical copy of 5th edition, so I don't know if the tax schedule was updated, because the latest tax schedule is as of 2018, and the 4th edition there was it was based on 2012 tax schedule. What she was talking about was this. One more. I don't know why Novia is not responding. She's the one.
I am here, Professor.
Okay, good, Novia. So you got the table of the tax schedule, right? You got it. Novia.
Yes, Professor, I am here.
Okay, you got the tax schedule, right? You got the tax schedule. Yes or no?
Yes.
Okay, good. Was it in the book? Was it in the book?
No, I didn't get the table because my book is 5th edition.
Even 5th edition, it must be there.
Where in the back? In the back?
In like section 2.3. In section 2.3 in the main text. But anyway, I thought you said you got it, but it says I did get the table. You meant you didn't get the table, huh? So she was Novia was sending me email about chapter 2 problem, and this was my actually someone also raised that issue. So I posted this on October 8th. Okay. A couple of students raised the question about, chapter 2 problem 2-2. If you have the copy of the print version, you might find table 2.3. But I personally don't have, the physical copy of the book. So I only have the physical copy of the 4th edition, and they used to have that table. But 4th edition had 2012 tax schedule, which is different from 2018. So I was hoping that 5th edition has 2018 tax schedule. But however, the tax rate is in that problem. Tax rate is arbitrarily given as 21%, right? Which is not based on the tax schedule. And then, average tax rate is, okay, all these things. I also said, I used the latest, referred to as in the older version. A student from section 1300 raised a similar question during the Collaborate on October 6th. The video is posted on my Yahoo. So you go to my Yahoo channel, Yahoo channel. What am I talking? YouTube channel. The playlist name is fnb100 Fall 21, and I explain and look up the video titled fnb100 1300-1300. That's section 13. F Fall 21 1006. And there it is well explained. So if you go to that channel here, this is not everything here. It's everything. Let me go to Fold 20, and then also I linked. Here's the file. Excel file, I linked to it. Okay, so if you click on that, and I have it downloaded already. So if you click on that, you will find, it's here. This is how I did that problem, right? The numbers, input data may vary. I mean, everyone will have different input data. I don't know. If someone might have the same input data, but it's not the input data. It's basically how it is done. And so you can look into that. Also, watch this video. Watch this video. FNB 1300. 100, 1300. Okay. 1006.
Which doesn't.
And there.
Doesn't mean anything because 1,000, right?
I'm explaining.
15, you pay 10%.
At the beginning of the video, someone asked.
And it was actually not very, because there was a tax change. So it's easier to explain with the more lower class, middle income. You made 77.
So please watch this because
one more dollar. We have some 1,600, 450. One more dollar will make.
At the beginning,
600.
I was explaining personal income tax. I didn't know if it was. I didn't know if it was about corporate tax because the student asked a question not specifying whether it was about corporate income tax or personal income tax. So I was going first about the personal income tax, and then at some point,
let's say your taxable income
student said, so from here, now it is, corporate income tax.
That doesn't go every bracket. Corporate,
So please,
this is personal.
Please watch this video.
For example, your corporate income is, taxable income is 10 million, and 10 million minus this, right?
And then
because you already paid this, and on that difference you multiply that by this rate. So corporate tax.
Alrighty, I'm not gonna continue with this for long because, but you have that file. The actual tax schedule, 2018 corporate tax schedule is like this. Okay, but according to this, then if this company's taxable income is this, right? Taxable income is this, earnings before taxes. This company's taxable income is this. Then if this company's taxable income is like in the $6 million range, so it would fall into this range. Okay, so then the tax will basically, they will have to pay the base amount, right? Base amount of this, and plus this minus the lower bound. Okay, so you can see what I did there. This is done correctly with the base tax amount plus the correct tax rate for EBT bracket. So tax rate E24. So this company falls into 34% tax bracket, times the B12, which is their taxable income, minus the lower bound, right? D24 is, of course, base amount. So the tax should be this, okay? But then this problem so when they revamped the book, when they revamped to 5th edition, they should fine-tune everything, but they didn't fine-tune everything. They need to it's a huge, very meticulous job, but they didn't do. They simply just put out the new edition without fine-tuning everything. That's why this happened. And in this problem, they just gave the tax rate arbitrarily, right, as 21%, which is baseless because it's not it's not according to the tax schedule. It doesn't follow the tax schedule, right? And without any base tax amount. So in the chapter problem, they would give you the answer like this. And then the marginal tax rate would still be, because they are not, and there's no way of knowing marginal tax rate because no tax schedule is given. And originally, marginal tax rate is if I make $1 more than current taxable income. If my taxable income is $1 more, what is that $1 more? What tax rate does that $1 more fall into? Well, it will still fall into this 34% because it's not going above this 10 million. I mean, if my current taxable income is exactly 10 million, if I make $1 more, then I will fall into this tax bracket. So my marginal tax rate would be 35%. In other words, that $1 more will be subject to 35% tax rate. But as long as I don't breach this upper bound, if I make $1 more, in taxable income, the marginal tax rate will still be this. In other words, marginal means one additional small increment. If I make $1 more, will I go in that? Will that $1 more go into the next bracket? No, because my taxable income is still is this, and if I make $1 more, it will still fall into this bracket. But again, in that chapter problem, there is no way of knowing that. There is no way of knowing that because no tax schedule is given. But actually, to do it correctly, you should ignore this and follow this tax schedule and calculate the tax by base amount, and then tax rate times, or taxable income minus the lower bound, right? For that portion, right? For that portion of difference, you pay 34%, and then you can talk about marginal tax rate because you can assume if I make $1 more, where would that $1 more fall into? It will still fall into 34%, right? So marginal, right? Okay. All righty. That's so that's it for today. Any questions so far? Any questions? Any questions? Okay, all righty. If you don't have any more questions, then I will say goodbye to everyone. Have a great afternoon. And I
Thank you. Have a wonderful weekend.
Thank you, Professor.
All right, you too, Jason. You too, Aisha. I will see you guys next Monday. Okay? All righty. We'll stop sharing, stop recording. All righty, Jordan. I'll stop recording and sign out.